only on Bloomberg Quint.
Hello and welcome. You're watching Bloomberg Quint, and today I have a very special guest with me. Joining me in this discussion on navigating through uncertainty, I've got the head of India at Nomura, Prabhat Awasthi. Prabhat, thanks very much for joining in. It's definitely very volatile times, and taking a look at the current scheme of things and how they are shaping up on various counts, be it domestic cues coming in, be it the geopolitical tensions, be it the trade talks, or just the fact that crude oil seems to be extremely volatile. From a market standpoint, how are you reading into these individually?
So I think, Devina, if you look at it, you rightly said, the macro environment has been uncertain and has been volatile. I think more important than uncertain, as you rightly alluded to, the fact that crude prices have been extremely volatile, and for a country like India, especially, which is crude being such an important sort of import item. Make it forecasting sort of, or looking in the, looking in the future makes it far more uncertain. I think overall, really, if you think as to what's going on at this point in time globally, I think there is no doubt that there's a bit of slowdown going on, and it might be because of various factors, and various factors might be applicable to various economies. For example, fading dividends of stimulus, fiscal stimulus in U.S. could be a thing, or a trade friction between U.S. and China. The fact that India had a liquidity shock, for example, and things like that actually, and the fact that we had rising interest rates in U.S. Initially, and that sort of put pressure on emerging economies. But net result essentially is that we are in midst of a somewhat sort of a synchronous slowdown globally, and that has implications in terms of how you sort of look at markets. But I think, frankly, the fact that you started from a reasonably good growth environment and slowly transitioned into a slow growth sort of environment has been, I guess, has got priced in, not only in terms of how you think about growth going forward, also because the fact that the monetary policy views have changed now. The view of Fed has changed from being much more hawkish to comparatively dovish. Same with RBI in India. I think we're sort of hoping that at some point in time, China also have a little stimulus. So we've gone from a massive rate hike sort of getting built into. So I would think a lot of this is getting priced in. And I think what you're seeing actually globally, except India, I guess, is the fact that some of that pricing is essentially leading to bounce back in markets, especially equity assets, because, as I said, the pricing in of growth risk happened first, and then the positivity surrounding the dovish monetary environment compared to before is now pricing in a sort of bit of positivity.
Prabhat, just the fact that, while you're talking about these being silver linings and the positive aspects of what the central banks are doing, is that enough to overcome the uncertainty that lies ahead for us in terms of earnings growth challenges that we are facing? No doubt, while Q3 did see a good earnings performance from the Nifty 50 companies, but the overall earnings growth has not been, as great as we would have anticipated it to be, versus the kind of valuations that India attracts. So in light of that, how would you position yourself?
So I think there are two. For the first aspect of this is that the fact that earnings growth, the slowdown incrementally, right? So you had a good quarter, but the slowdown has emerged post that. I think if you really look at the broad market, I think you will find that the broad market and equity asset prices have done much worse than the headline index will suggest. And be it mid caps or take out five or seven large performing stocks, and then you look at the index. Actually, index isn't quite badly. So I would think that broad market has actually taken it on board that the growth is slowing down. That's the first point. Secondly, I think the fact that growth has slowed down, the question you have to ask essentially is that how transitory it's going to be. And my view is that you probably will have a slowdown in the next, and it'll continue. We have a slowdown, will probably continue for good 3-4 months. But I would think that growth will start to pick up again in India because you've sort of gone. The impact of liquidity shortages will start to wane at some point in time. The fact that you had a rate cut, and the fact that you're not seeing so much of a BOP pressure now, the fact that oil prices were not 80, that they've gone up from the bottom, but they're still not 80, and your BOP position is better. Some of the effects of the earlier sort of things which cause rupee depreciation impacts will also start to wither away from consumption slowly. So I think you'll start to see what you're seeing actually probably is going to continue with probably the worst of it, and you will see economy start to bounce back. And I also remember that there's an election uncertainty, and that's a totally separate topic away from economy. The fact is that in next 3 months we'll be at least over that, whichever way we go, but we'll definitely be over that event. And that also is the risk event, and that's also weighing on asset prices. So as far as valuations are concerned, as I said, I mean, the point is broad market valuations, I think, have come down a lot. And all the clients that I know from my previous role, and people do say that there is a Nifty at 9,000, a Nifty at headline, but there's a broad market at 9,000. And I think the bulk of the stocks and asset prices in equity markets are much cheaper than the headline will suggest.
So would you say that while obviously the headline number for the index is somewhere around 10,800 odd, that's kept afloat primarily because of the top 2, 3 or 4 stocks on the index, which are those heavyweights which have held the index at these levels. But remove those and you'll still find Nifty at much lower levels than it's currently trading at, which could be a lucrative proposition.
So valuation-wise, for sure. I mean, if you look at those stocks and look at the stock prices have actually come down, right? And the earnings are not, as you said, they are not. There is no decline in earnings. So logically speaking, you become much cheaper over a period of time. And also the fact that price of risk in India, given the fact that interest rates have fallen somewhat, has come down. So essentially, you're priced in uncertainty, you're priced in slow growth, you're probably priced in uncertainty in election to some extent. I mean, I wouldn't say you can ever price in elections fully, but the fact is that I think it could be lucrative, yes. But as I said, I mean, there are still uncertainties going ahead, and that is elections being one of them. So. Yeah, but I would think that market, as you rightly said, is outside of those stocks is probably cheaper.
Taking a look at the markets from what aspect? Would you look at it from an earnings a multiple? Would you look at it in the sense of companies that are providing good return on capital employed to shareholders and investors? Or would you look at companies with healthy balance sheets, strong managements? Because now it has to be a holistic approach to investing in a company and not just looking at a number like earnings, because earnings are volatile in these times, and that's probably not the right barometer to invest in a company.
So it's a very loaded question, I think, because the fact is that, earning, first of all, I think styles of investing change depending on the macro environment. And, for example, for a long time, just the, pre-2007, it was the balance sheet heavy companies were doing well. Post-2007, the world changed, and the management and balance sheet light businesses have done, actually, I would say post-2013 even more so. I think the important point is that it is largely to do with the macro environment. For example, if the growth is slowing down and the stress in the economy is increasing, balance sheet heavy businesses tend to do badly, including financials. And when the growth is sort of bottomed out and is improving, then the heavy balance sheets do better simply because of the fact that the utilization of the balance sheet starts to yield higher returns. So I think what is important is, I guess, the incremental changes on the return parameters. And it's very hard to forecast because you have to focus a bunch of things, I guess, to get your growth right, first of all. As you said rightly, we discussed before, growth is uncertain. But you get growth right, if you can get, so I think the companies which do the best are the companies which are seeing improved momentum on their return ratios. And when the momentum is actually on the decline, then typically the companies which are protecting their return ratios tend to get priced up, which is what we've seen in India. So hopefully if the growth continues to improve slowly, not in the next 3 months, but over a longer period, then I would think that it'll become a broader market compared to a narrow market that we have seen in the past. But it'll be a process. It'll not happen immediately. I think in the end, if you really look in really fundamentally, then I think two things matter, right? Essentially, the free cash flow you generate, and that is dependent on the return profile of the business, because a low return profile business, even if it grows, cannot generate free cash flow. So returns matter, and I think cost of risk matters. So, if you look at what we're seeing right now is a slowdown. The cost of risk is coming down, but the growth perception is also coming down. That's why you're not seeing risk asset rally. But the growth perception was to change with cost of risk lower, then you will see a broader market starting to look up. But as I said, I mean, there's no, for the market, you have to look at like a stock only. You cannot look at market when you're looking at the market. It is actually conglomeration of, you can sort of say it's a conglomerate of its own kind with so many listed components. And the aggregate basis, I would think that if markets ROE is improving and the cost of risk is falling, that's a bullish case. We are not in that bullish case simply because right now, because the slowdown in the short term is there. But one part component of this, that is, the fact that you had, rising yields, seems to have been corrected at least. So you're waiting for the next phase. The growth comes back and political uncertainty, as I said, lifts. That could be very good for markets, broad markets.
And is that what even foreign institutional investors are waiting for that political uncertainty to, that overhang to get cleared before they actually start making any meaningful investments into India? Because the pipeline there seems to be pretty dry at this point. And now with the current geopolitical issues that have been rearing its ugly head, it just seems that it might take slightly more longer for them to get comfortable with the investment proposition of India.
So I think politics is a factor. I think it is an important factor, and I think that will continue to be the case. You cannot wish it away till May. So I think that will definitely keep India investments somewhat on the sidelines, unless the perception that changes, that you are going to have a stable government because of whatever issues. Maybe the polls start to indicate. Because the polls, opinion polls have been rather wishy-washy and don't indicate a certain outcome or probability of certain outcome being very strong. I think that is what is weighing. Geopolitics, I think, so unless something really goes terribly wrong, what we're seeing right now possibly is if nothing sort of escalates, then we probably will sort of, and I'm just talking with respect to India. I think so far as India is concerned, I think it is not that much impacted by trade friction issues. Somewhat, yes, but not dramatically. It's a domestically driven economy, not export driven, doesn't have dependence on export to China, etc. So I'm keeping those aside. I think really important is India's own politics and geopolitics. So if we don't really see an escalation in tensions, for example, the border, this will pass. But I think what will remain is the politics of it. And as I said, either the perception of the result or the actual results. I mean, one of those two things need to change. Actual results, anyway, we know when it is going to happen. But if the perception of the result changes, the asset prices, you could start seeing risk money flow back into the market.
Do you feel that while there are some telltale signs of NBFCs being able to raise funds now, and liquidity seems to be slightly improving, the full impact of that is still not visible across sectors, and you may actually see that come about in the second half. What's your take on this?
So I think systemic, as long as the systemic risk can be contained, I think that is the key, because, we have, frankly, if you look at the size of the problem compared to the size of the banking NPA problem, it's a smaller problem, right? Because the banking NPAs in absolute aggregate amount that got recognized over 2-3 years are multiples of what we have seen in the current NBFC sort of fear that we saw. So I think the problem with NBFC issue simply is that the lenders to NBFC, especially mutual funds, have to recognize a problem right away on NAV, and therefore, their ability to take defaults is comparatively lower because, outflows start to happen immediately, NAV goes down, and that exacerbates the crisis. Unlike banks, which can sort of have capital and can take those risks. So it's a sentiment liquidity issue in some sense, which, deepens the problem. So as long as the support from financial regulators and secondly government, and thirdly I think if we can sort of manage the system-wide issues from happening, then I think even if there are one or two companies which face issues in the in the second half, we should be okay. Because as I said, the size of the problem is not large. It's the nature of the problem because it's funded, a lot of these NBFCs are funded by mutual funds. And if they don't lend to them, then they'll have to basically, these guys just cannot do anything because that source of fund completely gone. And whatever problem the balance sheet get amplified. There's just no grease in the system. But my overall assessment is I think we should be fine. I mean, that's the call I would take because, as I said, I think macro liquidity will get better. I think the regulators seem to be committed to sort of generally sort out the issues. And I think save a shock, for example, it could be election shock, or it could be anything, frankly, save a shock, and shocks can still come. We should likely scrape through with sort of an orderly wind down of this problem.
While obviously you say that about the NBFCs, the thought now has shifted to banks which have a bigger retail book as compared to a corporate lending book. Earlier on, it was more the heavier the corporate lending book, the corporate-facing banks, they're the preferred bet. But now, slowly but steadily, because of the risk aversion that's there, a bank which has a larger retail book seems to be garnering favor. Is that a mindset that you would also agree to?
You mean to say the risk on retail books are higher? Is that the question that you're asking?
Yeah.
Well, I don't think so, and simply because of the fact that I think the thing is that the nature of lending in retail and the safeguards around it have gone up. And I would say that the infrastructure around retail lending, be it credit bureaus, the information sharing, etc., make sure that if you really are defaulting, then your access to credit gets stopped completely. So I think it's a very, very different proposition. That's something that is now being brought in to corporate world, right? For example, evergreening, etc., was much more easy earlier in corporate world, not really in retail world, and therefore I think credit behavior in retail has been better. So the first thing I would say on retail is that you must recognize that retail lending to GDP ratio in India is comparatively small, actually very small compared to all the economies of our size, and even our neighboring economies or global economies, etc. So we are not heavily levered in retail. There has been a lot of growth in retail, but that doesn't mean that your overall retail lending is too heavy. Second, I think, as I said, the systems are and the overall ecosystem of retail lending is very strong. So I think there might be a slowdown, mind you, because of the fact that there is some amount of slowdown that's happening on the consumption space. There might be incremental slowdown, but I don't think it'll be a systemic problem of the sort, given the fact that I think, as I said, ecosystem of retail lending is, I think, very, very strong.
So would you prefer corporate-facing banks or banks having a bigger retail book at this juncture?
Again, no good answer, no one good answer to that. I think there's a cycle. So retail, actually, if you look at last 10 years, retail really had not seen a cycle. I think it'll probably see a slowdown, but not an NPA cycle of the sort we saw in corporate lending. Corporate lending obviously is going to see a cyclical pickup, and it has sort of seen the worst days of NPA problems. So there will be a pickup there simply because of the fact that you've essentially written off that what you had to write off. and the economy is at the margin picking up slightly. The investment cycle, to whatever extent, got destroyed. There's a marginal pickup, not a whole lot, but definitely on the mend slowly. So therefore, the growth prospects and the NPA prospects of corporate banks have gotten better. That doesn't mean fundamentally the nature of corporate lending is not still risky. It is still risky, but it's just that you're right part of the cycle right now, and you might therefore see higher growth in profits. But if you really look at sort of, there were banks which are pure retail, there were banks which are pure corporate. I think it has become a bit of hybrid right now because the corporate banks have gone to retail and retail banks have gone somewhat into corporate. But likely scenario is that the corporate heavy banks will probably see a better scene simply because their valuations have come down and they are on the right side of the cycle. So you're looking at next 3-4 years, it's quite possible they might do better simply because it's cheaper and they are going to not have the same problems they had in the past, and therefore it will be able to grow reasonably well. There will be rising ROE trend, etc. overall. So I think in that sense, over the next few years, it's quite possible that you might see slightly better performance simply because valuations go up.
Okay. The next one is coming to what the government has been announcing and how it affects individual sectors. So while the budget left more money in the hands of the consumer, enough to make sure that consumer staples get that boost with the additional money that is in the system and with consumers. They also did a lot for the sugar industry. They also did, bring down GST rates for real estate, which has augured well for this pocket too, which has been in the doldrums since the last 3 or 4 years. How did you view the approach that the government has been taking in order to resolve some of the issues within these pockets?
So these are micro sort of, I think, issues which have been addressed. I mean, I would think that very broadly speaking, this is a pre-election budget, and it sort of lives up to it to some extent. I think it's not, they have not gone completely, they've not sort of blown the fiscal completely, but it's definitely there is some amount of fiscal stimulus that have been given to consumers in micro markets like agriculture, because of the distress and because of political compulsions. This is to be expected pre-elections. I mean, we've seen, a food security bill before the last election, for example. Even before that, there were massive fiscal stimulus. So this happens in India, unfortunately, Indian democracy. The question to ask, I guess, is that will it sort of lead to a massive macro problem going forward? And my guess is that so long as they can contain the overall fiscal deficit construct, in a reasonable manner, that is, unlike 2009, where he went from like 2.5% to 6% and central level, even more at overall consolidated level. As long as the overall fiscal construct is reasonably okay, I think we should not worry too much about the impact of the government policies. Obviously, you'll have a more fillip to consumption, especially rural consumption. But I'm still very circumspect about saying that staples will do well just because of the stimulus. Because if you go back to 2009, for example, 2009 elections, I don't think the growth in staples really picked up dramatically just because there was a massive stimulus, there was a Narega, there was so many things happened. I think. So I'm not really sure. I mean, we'll have to wait and see whether this impacts discretionary or consumer staples, what it does, where does the growth pick up because of this. Consumption will benefit in some form. And usually I've seen that discretionary income increases largely are more beneficial if you are doing a sector selection, for example, markets. Discretionaries do better than staples because staples anyways are expensive sector, and the growth has been robust and sort of visible, in the last couple of years. So it's probably gotten priced in. So that will be my 2 cents on this issue.
Right. Just one last question, Prabhat, and it's a two-part question. My first part, where I'll ask you to do a little bit of, crystal ball gazing, if you call it so, for 2019, the trajectory or the roadmap for the Indian markets, and the second part to the question being the biggest risk that you see to your first assessment of where the markets are headed.
So the problem with the crystal ball is that there's a cloth kept on it, and this will lift only after the elections, I would think. But so I think that's the biggest problem. I think for forecasting, there's a very sort of 1-0 risk that exists in India. I think the first proviso, I think, in whatever I'm saying is we get a stable. Sure. A stable government, I think, is the key.
Right.
Because unstable governments will essentially mean.
Yeah. While that one point you said is the cloth over the crystal ball, the other aspects are pretty much known. You have various other factors that you have information about. That one factor being a little bit uncertain, would that not be slightly more conducive towards telling us which direction it could take? It could be as mild as saying that you may not actually see a move on the index at all for the year.
No, why I'm saying it is that if you get an unstable government, then your fiscal bets are off. Because the fact is that if you really do get an unstable government, then the first priority of the government will be possibly because they will be uncertain and they're not sure that when the next election happens, they might just blow up the fiscal. That is the bear case or a problem case for India. That's why I'm sort of harping on the fact that you have a stable government, because beyond that, if the political compulsions are very different, then you will start worrying about fiscal, interest rates, inflation, everything post the government formation. Otherwise, I think the overall construct for India is this. You are essentially looking at a growth pickup. We have seen a growth slowdown, but I think fundamentally, structurally, growth is on the mend. Generally, a number of banking system has been cleaned up. A number of sectors which were in distress over the last 5 years have seen some sort of resolution of problems, be it metals, I think incrementally power, and we saw infrastructure, etc. I think your inflation is down, your rates are coming down. Growth in general in earnings was very anemic for the last 5 years. It is on the mend, might not be as strong as you'd like, but I think it's on the mend, and therefore, and the multiples, as I said, broad market multiples are not expensive. So therefore, what you probably will get is, at the minimum, sort of growth in earnings should be delivered in market returns, which is not happening at this point in time. In fact, globally, year to date, emerging market assets have rallied, and India sort of languished behind simply because of this. And I would think that if the unstable government is a 20% probability on an 80% basis, you should be actually well poised in 2019. So if the earnings growth is 15, you should get 15% minimum from the market.
Okay.
If not more, because your rates have fallen, your inflation is lower, etc. So that's what I would say. But I said there's a big proviso out there, and we are not. I'm not subject matter specialist on politics, and things change very quickly, as you know, in political world. Things can change because of events, etc. So I think we have to keep an eye on it.
Prabhat, it was a pleasure chatting with you and getting your thoughts on this particular platform. Thank you so very much for joining us this morning.
Thank you, Devina.
Prabhat Awasthi there with his thoughts on India as a whole and what the Indian markets could likely do come 2019. Thanks a lot for watching.